Welcome to The Explainer. Today, we're doing something a little different. We're looking back from the not-so-distant future of June 2028 to figure out a critical moment in our economic history. It was a time when we were standing on a knife's edge, between a major crisis and incredible prosperity. We tipped toward the boom, and we're here to explore exactly how that happened. So, back in early 2026, the consensus view was, it was pretty grim. The forecasts were all calling for this devastating global intelligence crisis thanks to AI. They were talking mass unemployment, a brutal market crash, but what actually happened? The complete opposite, a global intelligence boom. So the big question is, how did practically everyone get it so wrong? And what was the exact moment our reality split off from that pessimistic script?
To really understand the boom, we first have to go back to the panic. In early 2026, there was this viral memo floating around that predicted these new, powerful AI agents would just decimate white-collar jobs. It led to this thing called the SaaSpocalypse that cratered software stocks and sparked, widespread anxiety. And this right here, this pinpoints the single fundamental mistake in all those scary crisis models. See, they correctly identified the first thing that would happen, the first-order effect. AI could definitely displace certain tasks. But they completely missed the crucial second step, the second-order effect, how companies would redeploy the resources and capital that AI freed up.
This brings us to the crucial divergence point. This is the moment the boom path became pretty much inevitable. And the first clue that reality was going to split from those fearful predictions, it didn't come from some government report or an academic paper. No, it came from corporate budget decisions.
This quote just reveals the dynamic at play perfectly. Companies were, for sure, using the threat of AI to renegotiate their big software contracts and save a ton of money. But instead of just pocketing those savings, they started plowing that capital back into new, human-centric roles. They realized they needed people for strategy and coordination to figure out the what, not just the how. And this process created a really powerful second-order effect. The flow was simple, right? Companies used their AI leverage to get contract savings, and then they used those savings to fund entirely new teams. So AI-driven efficiency became a catalyst for job transformation, not just job cuts.
This transformation, it went way beyond just software companies. The big fear was that AI agents would destroy all the intermediaries, think real estate agents or food delivery platforms. But that's just not what happened. Instead, AI acted as this powerful quality filter. It stripped away the value that came from things like customer confusion or just inertia, what we can call friction, and it rewarded companies that had genuine underlying value or substance.
The DoorDash example is perfect. The prediction was that AI agents would kill their business by just finding cheaper options. And yeah, their take rate, the fee they charged, it did fall from 15% down to 9%. But their real advantage, their moat, wasn't the fee. It was their amazing logistics network. The AI agents recognized this, and boom, order volume exploded by 40%. They became a higher volume, lower margin business, proving their operational substance was the real deal.
So, we've seen how individual companies adapted. Now, let's put on our professor hats and look at how these individual decisions ignited this powerful economy-wide feedback loop. This is where a story about one sector became the story of the whole economy.
At the very heart of the boom is this concept, the intelligence amplification spiral. It's a virtuous cycle. Think of it like this. AI makes workers more productive. That productivity leads to higher wages and profits. That, in turn, fuels more spending and investment, which then funds even more AI adoption. The economic pie wasn't just resliced, it actually started growing and faster.
So here's the step-by-step process. First, AI augments workers, which causes a big productivity surge. This shifts labor demand over to new AI-adjacent roles, which tightens the job market. Then, to get the talent they need, employers have to compete, and they share those productivity gains through higher wages. And finally, confident, higher-earning workers spend more, which drives the whole cycle forward all over again.
And that number right there, 3.6% unemployment, that was the linchpin. That was the key. With the labor market consistently this tight, employers had no choice. They had to share the gains from AI through higher wages if they wanted to attract and keep the people they needed. This became the main distribution channel for all that new wealth.
So the result wasn't a jobless future, not at all. While about 9 million roles were displaced, the economy created 11 million new ones. That's a net gain of 2 million jobs. And these were jobs that barely even existed before, like AI systems architects, augmentation consultants, and AI quality assurance specialists. Okay, so the strength in the real economy then spilled over into the financial markets, and that created a secondary feedback loop that basically acted like a supercharger. Rising asset values made people feel wealthier, more confident, while healthy credit markets kept the money flowing for business investment.
This timeline shows just how fast that financial picture turned around. We went from panic in the private credit markets in early 2026 to a stable, Goldilocks 10-year Treasury yield of 3.8% by the middle of 2027. And Goldilocks means it wasn't too hot to cause inflation, but it wasn't too cold to signal a recession. It was just right, reflecting a market that really believed in sustained, non-inflationary growth.
Now, a boom this rapid could have easily spun out of control, but a surprisingly adaptive policy response helped build the scaffolding needed to support the transition, and it guided the economy from what could have been a chaotic boom into a period of stable growth. The booming economy generated this massive fiscal deficit. With more people working at higher wages and companies making higher profits, federal tax receipts surged 8% above what was projected. And this windfall gave the government the resources it needed to actually invest in the workforce without, blowing up the deficit.
And that investment was targeted. It was modeled on Singapore's super successful Skills Future initiative. The government funded these rapid retraining programs. By 2028, 2.4 million Americans had completed these AI upskilling courses, which helped displaced workers move directly into those new, high-demand roles.
So when we look back, the entire boom, the whole reason we dodged that catastrophic crisis, it really rested on three fundamental pillars, three core truths that the pessimists completely missed.
So here are the three pillars. First, the demand for intelligence isn't a fixed pie. When AI made analytical intelligence cheap, we just demanded more of other kinds, like creativity and strategy. Second, a strong job market is the most powerful tool for sharing productivity gains broadly with everyone. And third, our companies and our government adapted far more quickly than anyone gave them credit for.
So, what's the single most important takeaway from this entire episode? It's this. Machine intelligence ultimately acted as an amplifier of human capability, not just a replacement. It augmented us. It made us more valuable, not obsolete.
And that brings us to our final and really crucial thought. We've been talking as if this is history, right? But the source material leaves us with this powerful reminder. This optimistic future wasn't guaranteed. It had to be built through smart corporate strategy, responsive policy, and individual adaptation. The choices that we're making right now, those are what will determine which of those two futures we actually get.